This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this episode is Ryan Kelley and Josh Wein, co-portfolio managers of the Hennessy Gas Utility Fund. We're going to discuss natural gas, electronic vehicles, and utility investing, and everything that investors need to know about the space today. Great to have both of you on Viewpoints by Hennessy.
Good to be here.
Yeah.
All right, let's jump right into it. Ryan, what is the current state of the gas industry today?
Well, I'd say the gas industry is in good shape right now. A lot of the same sort of reasons why we like natural gas, we like the natural gas utilities, continue to hold true. It's an industry that continues to grow. Natural gas continues to be a very important part of the overall energy complex in the U.S. These companies have advantages for being a utility. Strangely enough, we like regulation. A lot of other industries may not like regulation, but it kind of, in a way, protects these companies. It even helps to hold up their revenues when revenues are lower, and their costs when they're going up as well. So it's a complicated structure, but through the regulatory process, you can recoup a lot of your expenses when you invest in your company by essentially charging more for distribution. So these companies are slow and steady, strong long-term upwards growth in earnings, in capex. And interestingly, right now, we're in a period where, again, these utilities are slower for the most part in growth. But right now, because of reinvesting in themselves, reinvesting in pipeline replacement for electrics, it's going to be reinvesting in the grid. That's going to be very important. Earnings per share growth, capex growth, all in the 5 to 7 and higher % range per year, versus in the past, utilities are much slower growth at around 3 to 5%. So we're in a really nice space right now as far as the companies go and as far as the opportunities that they see.
So Ryan, just as a follow-up to that, how should investors look at the natural gas production and demand dynamics today?
Yes, we are, 2022 was record levels of natural gas demand in the U.S. and record levels of production. So we continue to see that going forward as well. There is plenty of natural gas out there in the United States. It's easily accessible. We have the infrastructure to get around the country. Arguably, we should actually have more pipelines. There are certain parts of the country that are not getting the natural gas. New England, for instance, very close to some very, very large production areas in Pennsylvania and New York and West Virginia, and yet we don't have the capacity to get it up to New England as readily as other parts of the country. But overall, demand very strong, production very strong. One of the things that we're going to see here in the next 5 to 10 years, as we see industry coming back to the United States and we see manufacturing coming back to the United States, natural gas is going to produce a lot of electricity for these companies. Natural gas will also be an input for some of these companies as well in their manufacturing as that continues to grow.
So Josh, there's a lot of attention given to clean energy. Could you define what clean energy means to you and how investors should be looking at the space?
Sure. Yeah, it's definitely a topical question. I mean, clean energy is anything from, energy derived from solar or wind or geothermal, or in many cases now, increasingly, it's renewable natural gas that might come from, a farm or a landfill. I think ultimately, it's important to set it up. About 20% of electricity generation is from renewables. That's doubled in the last 20 years, give or take. And that's a great story. And that growth of share might accelerate a little bit as we go forward. I think the other side of it, though, is that there are no fewer than about a dozen states that generate the largest part of their electricity from coal. So I think that the message is that it's exciting, and having natural gas coexist with renewables is a great way to kind of have a portfolio of sources that will stabilize each other. But it's going to be slow. It's not you have to crawl before you walk. And I think we're walking right now, but we're certainly not running. And I don't think anyone should expect that really anytime soon.
So Ryan, natural gas bans have been a bit of a controversy here lately. What do investors need to know, and how do you look at it?
Sure. Obviously, a lot of big headlines around the country. It started with Berkeley a few years ago, banning new natural gas hookups into new construction. New York State was one of the most recent ones to ban natural gas as well. And one quick thing to make sure that people understand is they're not banning the use of natural gas going forward. They're banning in new construction, in building new residences, in manufacturing, in restaurants, not having natural gas as one of the energy choices for those customers. And that's really what it comes down to. We think that, this is obviously a lot of headlines. On the flip side, there are about 20 states now that have already done this, and 15, I believe, that are in process of banning the bans, which basically means the state legislatures are passing laws that basically say an individual jurisdiction or an individual city cannot just ban natural gas. It needs to be a bigger decision than that. So that's on the flip side. You don't hear about that quite as much as you hear the actual bans themselves. But I think that overall, these are not. It's not a huge worry, I think, for investors. If you're looking at the space, if you're looking at natural gas, if you're looking at the natural gas utilities, there's still plenty of, I'd say, decades worth of growth out there when it comes to overall the U.S. is just using more and more energy, and natural gas is a big part of that. And we're exporting more, which Josh, I think, will talk about later. So there is just a lot of still growth out there, and that these bans are not that huge of a deal for investors.
And a great segue there. Josh, how should investors look at US LNG shipping over the next couple of years?
Yeah, so it's an exciting story that didn't really exist even 8 or 9 years ago. So, first and foremost, the idea that we are exporting LNG to, primarily Europe and Asia is something that certainly geopolitically is a great thing. We are in control of our own destiny due to the abundance of natural gas and the accessibility of it. But, in the last 4 years, the exportation of natural gas has grown fourfold. And this year, it's estimated by the Energy Information Administration to grow about 14% and kind of high single digits next year. So it's exciting. It's something that speaks volumes about our fund, which relies heavily on, obviously, the transmission and distribution of natural gas. But it's also just an interesting story geopolitically and economically. I'd also point out, it's an infrastructure story. So as the administration, hopefully, allows for more efficient permitting and more of a focus on infrastructure, I think this will make a lot of sense and resonate with investors. It's interesting. It's not too long ago that these exportation facilities were set up to import natural gas. It was thought that would be our path forward. And here we are in 2023, I think it's the second largest exporter of natural gas, just a little bit behind Australia. So it's an exciting story and one that's only begun to get some airtime.
So Ryan, how will electric vehicles impact the natural gas industry?
Well, believe it or not, immediately it will increase demand for natural gas. I mean, it's that simple. Right now, with more and more EVs on the road, more and more demand for electricity, that means that we just have to produce more electricity and produce it quickly. And we can't just all of a sudden build a new turbine and put up some new solar panels overnight and get that energy. So right now, it's a big boon for the industry for natural gas because, electricity, about 40% of all electricity is produced by natural gas on a large utility scale. So that's good for it. Over time, you're talking a little bit about sort of the electrification of everything, I'd say. And that's also a good opportunity for the industry as well. I mean, our fund has both electric and natural gas utilities and combined utilities. And so the electric side will benefit from this increased demand. But also when it comes to peak days, when it comes to, the hottest days in the summer and the coldest days in the winter, those are peak demand days. And natural gas is really pretty much the only way to meet that peak demand right now, and probably for the foreseeable future. You would need to have massive amounts of batteries in order to meet the amount of electricity demands that come onto play when it's 110 degrees in Texas for 5 days in a row. So, natural gas is very important. It's important right now, just in the way we normally use it, but it's also very important as we continue to see more demand for electricity, more use of EVs, and more conversion to electricity over time.
Yeah, that makes a lot of sense. Let's pivot and dig into the Hennessy Utility Fund. Now, this fund tracks the AGA stock index. Josh, what is that index?
Sure. Yeah. So the AGA stock index is comprised of the publicly traded members of the American Gas Association. So there are currently 50 members that are publicly traded, and it's focused on the distribution and transmission of natural gas. So, any member of the AGA that is involved in that would be part of the portfolio. And so it's both utilities as well as what we call energy. And I think it should be emphasized that's more pipelines and LNG exportation and not exploration and production. So ultimately, the AGA stock index is not one that necessarily lives and dies at all by the price of the underlying commodity, which is natural gas.
So Ryan, what is the portfolio construction process of this index and hence the fund?
Yeah, so of those 50 companies that Josh mentioned, essentially this is a market cap weighted index, but it's then modified by the percent that a company is sort of dedicated, exposed to the natural gas side. So you end up lining up all of the companies in the index, market cap weighted, so the biggest ones will be up top and the smallest ones will be down below. You then look at their individual balance sheets to see how much natural gas as a percent of their assets. We call it the gas assets percent. You multiply that times the market cap and you come up with a new weighting. So what happens is a company like One Gas, which may not be as large as some of the other companies on a market cap basis, gets 100% weighting because it's all natural gas. It's a pure play natural gas utility. So it's a higher relative weighting in the index. And then, say a company that's more of a multi-utility that has 80% electricity and only 20% natural gas, that would be a much lower weight if it had the same market cap as One Gas. So that's how it's constructed. It really overweights the natural gas utilities. And then one other thing that we do is make sure that, the index is designed so nothing is greater than 5%. So it caps, I think there are 8 companies currently that hit that 5% level.
Okay. And so is there a predetermined rebalancing schedule for the index?
Sure. Yeah. This is the index is kept by a third-party index provider, and they recalculate it once a month and send over the new weightings if there's any changes in the gas assets or market caps, as well as from time to time you get new companies that come into the index, and then of course acquisitions would mean that companies leave the index.
Yeah. In any sector or subsector limitations for the index?
No, it's the only limitation overall is that 5%. But you end up just owning whatever those companies are that are publicly traded and part of the American Gas Association.
Got it. So Josh, the top 10 holdings of this index make up roughly 50%. As of today, Berkshire Hathaway is the largest holding. How does a company like that end up in an index like this?
Yeah, so it's interesting because Berkshire Hathaway is obviously known more for insurance holdings like Geico and even holdings in furniture and candy and all sorts of various businesses. But Berkshire also owns a unit called Berkshire Energy. So Berkshire Energy is comprised of 11 units. One is, Mid-American Energy, which is a traditional utility. And also they own, the largest interstate gas pipeline in the country, which services 11 states. It's about 14,000 miles of pipeline. So ultimately, when you look at a company as large as Berkshire and look at their balance sheet, it's about 2.5% of the balance sheet is gas assets. And so as Ryan said, the calculation ultimately gets you to a 5% weighting, which is the max. And so Berkshire, as well as 7 others, are at that 5% max weighting.
Interesting. So Ryan, utilities make up about 65% of the index in the fund. Which holding best illustrates why the utility sector is so important?
Sure. I mean, I think you could go with a few, but I'll talk about Duke Energy. DUK is the ticker. This is a company that has both. It's a multi-utility, so it has both electric and natural gas. It's in a fairly good area of the country. North Carolina, South Carolina. It services many customers there. There's a nice growth component in those markets, and that's always helpful for these utilities because they are constrained geographically where they do business. So you need to have that area growing. But all those are sort of specific to Duke itself. What's more important, and it sort of illustrates where the opportunity is for the overall fund, I'd say, is this push towards renewables, towards the electrification of everything, towards more EVs, stuff we've already talked about. Companies like Duke are going to benefit substantially from that. This is going to happen because they provide the electricity that's needed for all that. Their grid, the grid itself in the United States is way too small for what we're going to need going forward. So to the extent that Duke and other companies are reinvesting, expanding their part of the grid, getting more capacity online, and then of course they also would benefit, as many other companies, with adding in more renewables. If companies can build new power plant or new solar and build new wind farms and do that all through the regulated part of their business, then they're able to pass those costs along to customers and make a 9 to 10 to 11% ROE. So this story right now of a transition in energy in the United States, it's going to benefit many, many, many utilities. And we're talking about decades worth, not just next year or the year after that. So I'd say Duke is a good example of a company that will continue to grow because of this transition.
So Josh, energy makes up about 30% of the index and fund. Which holding in this sector is really the most compelling story for you today?
Yeah, I think, I don't know about compelling, but certainly the most interesting, and we talked about LNG exportation. I would say the most compelling story could be Cheniere Energy. So it's one of the few pure plays on LNG exportation and has been around the longest in that space. So I think, Cheniere is certainly a great proxy for where we are in, the exportation of liquefied natural gas and certainly is front and center in the, the discussion around it. So I would certainly encourage investors to look at that company. I think it's certainly interesting, intellectually, and also, as an investment, it's certainly interesting. I wouldn't necessarily recommend it or not, but it's incredibly interesting and certainly something that we spend a lot of time, looking at.
Excellent. Well, gentlemen, I appreciate you coming on Viewpoints by Hennessy. To learn more about the Hennessy Utility Fund, visit HennessyFunds.com. That is HennessyFunds.com.